Hello, guys. Welcome back to our SBL series. Our session, the last one recording, was interrupted because of firecrackers going all crazy. So I thought I'll record it at a time when firecrackers are not such a big problem. We had left off our discussion at the risk register point. So I would want to quickly revisit the risk register, show you a sample risk register, and then we can take it from there. Now, the risk register, which is in many ways, it's a it's the cornerstone of organizations' risk management because it provides a systematic documentation of major risks and enabling directors to understand the essential components of the risk and understand the risk profile. Basically, you will gather information about a lot of different aspects, which is risk description, comprehensive details including event type, size, frequency, and characteristics, interdependencies. If this risk were to actually come to life, what all would get impacted in the process? If this risk actually comes to pass, are there other elements in the business that will get affected? What is the impact of the risk, financial and otherwise? What is the priority? How high does it rank? Is it priority one, which deserves your utmost attention, or is it just a warning sign and you need to act, but not so quickly? Then, who is the person responsible for handling the risk? The risk owner, and then, of course, the response plan. How do you plan to tackle each of these risks? To show you a simple example, something like this is what a risk register will look like. Now, because the risk register is not it's not like balance sheet prescribed under Schedule 3 of Companies Act. This is not a fixed format. You can change it the way you want. These are some of the basic points that should always be covered. For example, if the risk category is R4, I mean, this is risk ID, okay? 1, 2, 3, 4, you have numbered the risk. R4 is loss of market share due to weak casual footwear offerings. They don't have, they only offer formal footwear. They don't offer casual footwear. The risk impact is high, the chance or the likelihood or the probability is also high. What is your response? You want to avoid the risk, and who is the owner? The who is the owner is and who is responsible for managing this risk? It is the marketing director. For internal audit lacks independence, internal auditor reports to CFO. This is a medium level risk. And who is the person responsible for tackling this risk? It is the chairperson. So this is how a risk register is prepared. It is a comprehensive document which profiles all the risks in a company. Again, as I'm telling you, these are some of the basic fields you can add to it. Make sure that these fields are there so that it captures the risk faced by the entity and it also captures the finer nuances. Okay, now talking about heat maps, I think we had a brief description on heat maps. It is a very powerful tool in risk communication. A heat map plots probability on one axis and impact on the other. So when you talk about a heat map basically tells you how impactful that particular item is and how deeply does it run. So a red color primarily in a heat map would tell you about how strong is so its impact is also very deep and the likelihood is also quite high. Okay, so let me show you a heat map to begin with. Okay, here, if you can observe, this is a heat map. The right hand top corner, as you can see, is deep red, whereas this one is green. The human mind is also trained in a particular manner, wherein you can say that the moment you look at the color red, you know that this is a risky area which has a high impact, high likelihood, whereas a low impact, low likelihood area is basically your it's not something that you need to be scared about. Now, what is high impact and what is high likelihood will depend upon facts of the case, will differ from situation to situation. Okay, and the entity should be able to map it properly for one and all to see. Now, let's have a look at, how does a risk map or a risk heat map function? Okay, the point that I want to remember is always show the residual heat map, that is the risk that remains after controls are applied. Now, when you explain a heat map, or when you are trying to understand it and explain it to your team members, understand that on the horizontal axis, okay, on the horizontal axis, what you have is the impact. On the vertical axis, what you have is the likelihood or the probability of risk. Okay. Now, red squares Say for example, single supplier dependency. Okay, it will be placed at the top right hand corner. There has been a historically say there has been a 50% probability of late delivery, and the impact is that a production stoppage would cost you 25 crores. Now think about expected annual loss from, say, for example, customer complaints. It has a low probability. It could have a high impact, but probability is low. So accordingly, it will find its way on the risk heat map. Okay. Now, an exporter in Mumbai, the hedging policy moved currency risk from red to amber. On a global level, think about cybersecurity risk can move from red to amber after an SOC implementation and cyber insurance. So it depends upon where exactly what protective measures have you applied, and on the risk heat map you should only show the residual risk. Okay, residual risk means risk that remains after a hedging technique or some other tool has been applied. Now the idea is that, see, risk awareness cannot be a management level discussion. Risk awareness has to be spread across the organization. So everyone, right from the front lines who are actually working on the projects, right up to the top management, everyone has to be involved. Now, see, culture starts at the top. Like the Tata Group companies, they run leadership risk dialogues quarterly. When the CEO speaks candidly about near misses, and people also speak up. Now, there are three practical levers that you can think about when you are embedding risk throughout the organization. First one is, of course, cultural integration, then process embedding, and then behavioral change. Okay. Cultural integration is introducing risk awareness as fundamentals to organizational culture, mission, and daily operations rather than separate compliance activities. Your daily task list should contain a description of how ri- how each of these areas could be susceptible to risk, and it has to be made a part of their regular DNA of how they work in the organization. Okay, then it has to be, when I say it has to be embedded in processes, say for example you are into food processing. Okay, so you should check, there have to be checkpoints introduced at each stage so that the material is checked before it is packed. Okay, now these could include different types of pH test, for example, which is the potential hydrogen test, to find out something about that particular, to find out how acidic or alkaline that product has turned into. Then you will also have to understand at each stage, what are the places where spoilage could occur. Is it sitting without getting refrigerated for some time? So all of these, at each step you will have to perform these multiple steps, and each of these steps will go towards creating a process at which the exposure to risk is mapped. Now, for example, at Plutus Education, or any other company, where you are talking about, my risk is that students who have not authorized or who have not paid for a particular batch have enrolled for a particular batch. Okay, if that is the concern, then what I should be looking at is, I should include, say, for example, multiple controls, like the person who is enrolling the student, the person who is collecting the fees from the student. You will have to ensure that he issues a receipt to the student so that he does not pocket the money, and he does not benefit at the expense of the company. Then the person who is collecting the fees from the student should not be given access to the system to get the student enrolled on the LMS, because if he is given that access, he might enroll a particular individual without collecting any fees from that person, or he could pocket, or he could say to a student that pay me 50% of what you would pay Plutus Education, I will give you LMS access. So this way it is quite possible that there could be revenue leakage. So that is a risk here. And how do you make sure that this risk does not come to life? The person who collects fees from the student and the person who has access to the LMS should not be the same person. Okay, and there has to be a daily check which will basically reconcile the cash collection with the number of enrollments with the LMS access on a daily basis. Once LMS access is given, and that person is he is now a part of the business, he is now a part of the batch, Then you will also have to ensure about how the class link goes to the student. Okay. Now, if the class link is unmasked and it is getting sent over WhatsApp groups, how difficult is it for anyone to copy that link, send it to another person, collect fees from that person, and just simply include him in the and just simply include him in the batch, and Plutus Education again will not receive any fees. So ideally at this point you should be able to mask the link in such a way that it can only be directly sent to the student, but the link is not shareable on a group. So at every step, I am embedding some control in the process so that revenue leakage can be stopped. And behavioral change is the last one, transforming risk management from periodic activities to continuous assumed practices integrated into reward systems and performance metrics, reducing the number of defective products manufactured. Okay, if it goes below a particular threshold, the number of defective products, then you could introduce some incentive or you could introduce some reward for that particular individual. So it can be a carrot and stick policy. It could be an approach which incentivizes the reduction of risk, and using this particular technique, you could get people across the organization to fall in line and work for overall risk removal. Well, removal is a far cry, but yes, risk reduction, of course. Now, risk implementation procedures. The COSO ERM model recommends systematic procedures for embedding risk awareness throughout the organization. These comprehensive approaches ensure consistent risk consciousness across all the levels and functions. Now, how does it work? First of all, comprehensive induction, risk management training for all new employees as a standard onboarding process. So when I joined EY, and this I'm talking about 2016. Yes, I joined EY in 2016. So back in the day, the company had an anti-money laundering training that we had to perform. Then there was a risk-related induction that happened, and there was a test also that followed the risk induction training. And we were not allowed to begin work on any of the clients unless that particular training was complete. Okay. Then talking about contract integration, risk responsibilities explicitly included in job descriptions, employment contracts, and employee handbooks. So, specifically for organizations, where risk exposure is high, maybe you are a payment bank, or you are doing a cloud based, your work is cloud based and your data is stored that way. It is critical for the company to keep on reiterating that fact to the employees. So, and of course, the employees need to be aware of the implications of their actions should a risk actually come to pass. So for that reason, the penalties that they will have to bear in case there is the penalties they'll have to bear in case because of them the company is exposed to certain risk, that is included in the employment contract. The do's and don'ts are included, and the employee handbook contains all the relevant details. The policy accessibility is something, basically what entities do is in your HRMS, that is your daily login for attendance and salary slips and all of that. These policies are embedded on the login itself. So when you log in, you have to first of all read through the policies, perform the e-manual and e-training, pass the assessment test, and if you are ever confused, the policy is always published on the portal, and you can just click on it, download, and continue. Then continuous education is regular training updates. EY used to conduct, a quarterly training for us for new joinees, and if there is a new policy update, then everybody else would be updated through continuous education and regular communication. If there is something, that they want the employees to be aware of. For example, back in the day, I remember there was some virus or some malware. It would take control of your system and you had to pay in bitcoins or something in order to retrieve your data. So when such a malware is introduced in the market, you immediately get news regarding that on the on your company email ID. Then a critical part of understanding the strategic risk strategic response to risk is understanding the TARA framework. Now, what is this TARA framework? The name itself is contains the clue to what this system is all about. Okay, it is a strategic risk response framework, and what all does it contain? It speaks about four responses to a risk situation. For example, uh, T stands for transfer, A for avoid, R for reduce, and A for accept. When I say transfer the risk, what does it include? So these are those items which have a high impact but low likelihood. Okay. Reduce risk through external mechanisms, including insurance, hedging, outsourcing, strategic alliances, and contractual arrangements with independent parties. Before I dive deeper into, understanding the Tara response strategies, I would want to emphasize on the fact that this is like a favorite topic in the SBL exam, because risk is a favorite topic in the SBL exam, and examiner favorite models is Parametrics is one of the examiner favorite models. It is a core part of enterprise risk management. Not only is it important for the exam, it is also important in your real life as well. Okay. The response to a risk depends upon the likelihood of occurrence, what is the impact if the risk comes to pass, the organization's risk appetite, and the cost versus benefit part of managing it. You can think of TARA as a 2 by 2 matrix. Transfer is when the risk is financially measurable and can be shared or shifted to another party, typically through insurance, outsourcing, or hedging. The goal is to protect against large financial losses while still pursuing the activity. How do companies, what does the transfer part involve? It involves insurance, transferring operational or catastrophic risk, hedging, transferring market or price risk through financial contracts like forwards and futures, or passing a part of liability to partners through indemnity clauses. Now, Indigo Airlines, it has to get involved in fuel price hedging, because see, jet fuel or aviation fuel accounts for roughly 40% of their operating cost. To transfer fuel price risk, Indigo enters into fuel hedging contracts. These financial instruments fix the price or compensate for price spikes. Okay. Um, Reliance Industries, they have insurance for their refinery assets. Their Jamnagar refinery, one of the largest in the world, is insured under property and business interruption policies worth billions. The firm transfers potential losses from fires, explosions, or shutdowns to insurance providers. And companies like, IT companies like Infosys and TCS, they have client contract clauses. In outsourcing contracts, Indian IT firms include liability caps and indemnity clauses that transfer some client related risk back to the client. For example, if a client delays feedback or testing, the vendor isn't penalized for schedule overruns. Okay, then the avoid part, don't take the risk at all. That is what it would stand for. When the likelihood and impact are both high and the potential downside outweighs the benefit, the organization decides to not engage in that particular activity or withdraw from it completely. Tata Motors pulling out of the passenger diesel segment. With India's move towards, more and more EV vehicles, that is electronic vehicles, Tata Motors realized the cost of upgrading diesel engines outweighed the potential returns. They avoided further investment in diesel passenger cars and focused on EVs and petrol vehicles. The result is better alignment with regulatory trends and public sentiment. Amul, no entry into alcohol-linked dairy beverages. Despite opportunities, in alcoholic daily mixers like cream liquors and all of those, Amul consciously avoids the segment due to its strong family-friendly brand positioning. Avoiding this protects its core brand reputation and stakeholder trust. HDFC Bank, it avoids crypto trading exposure explicitly because regulatory uncertainty from RBI. You don't know how that will go, and you would not want to enter into an area which will spoil your image for worse. The reduce option, when the risk cannot be eliminated or entirely transferred, you can reduce its probability or impact by strengthening controls or processes. The goal is to minimize exposure while keeping the business opportunity. How companies do it is they could do it through internal controls, safety measures, training, diversifying suppliers, all of that. See, Maruti Suzuki, single vendor dependence. To reduce single vendor dependence for component manufacturing, it has implemented dual sourcing policies. This reduces supply chain disruption in even during events like COVID lockdowns. Infosys, the cybersecurity investment, Infosys invests heavily in firewalls, encryption, and cyber training to reduce operational and data breach risk. After multiple global breaches in IT vendors, Infosys established a dedicated cyber defense center in India and Europe to monitor 24/7. Okay, Toyota diversified suppliers after the 2011 Fukushima disaster to reduce disruption risk. Apple invests in privacy features to reduce regulatory and reputational risk. And of course, the last one is to accept low likelihood, low impact issues, learn to live with the risk in a conscious manner. Monitor, review, and plan contingencies instead of spending excessive resources on control. Okay, because the probability is low and the impact is also low. Flipkart, logistics delay risk during festivals. During Diwali sales, Flipkart does accept that delivery delays are inevitable. Rather than over investing in temporary capacity which is uneconomical, they accept the short-term risk but have escalation protocols and proactive customer communication in place. Or for minor frauds, or for minor frauds in banks, SBI and all of that, all of those accept that a small percentage of NPAs or card fraud is unavoidable. They manage it through provisioning and fraud monitoring rather than trying to eliminate every small incident, which is only going to lead to a waste of time. Okay, in your SBL exam, the Tara matrix is important. You should be able to link it with the scenario and give a very clear indication of whether to transfer, avoid, reduce, and accept. Just telling that, okay, take up this particular approach is not enough. You have to give a detailed explanation behind why that particular activity is required and why that is the right way to basically tackle the risk at this stage. Okay. Now, risk spreading and diversification strategies. What are risk spreading and diversification strategies? We already spoke about, the Tara matrix. Okay. Now, when we are talking about risk spreading, they are common strategic choices, but they do have trade-offs. Okay. So, the reason why you diversify is because you want to smooth earnings and avoid concentration in one particular area. Okay, now, how does that help you in risk management? Let's try and understand. See, when we talk about diversification, what is it that we should be focusing on? It's not that diversification is the answer to all your problems. Okay, see, risk spreading means not putting all your eggs in one basket, distributing the exposure across different areas, products, geographies, suppliers, or investments, so that the failure of one doesn't cripple the organization. Diversification is the strategic form of risk spreading, expanding into new markets, products, or industries to reduce dependency on a single source of revenue or risk. And why it matters so much is, see, strategic leaders face two simultaneous challenges: maximizing returns for stakeholders and minimizing volatility in performance. Risk spreading and diversification help achieve both by reducing exposure to any one economic factor and protecting against shocks, supply chain disruption, regulation, competition, or geography specific events. And of course, stabilizing long term profitability and cash flow. At the operational level, see, diversification is about micro level uh, resilience also. For example, Maruti Suzuki. During the 2021 semiconductor shortage, Maruti faced production halts. Since then, it's diversified its supplier base, sourcing chips and parts from multiple vendors and even different countries. It is also building domestic manufacturing capacity to reduce reliance on imports. Amul, the farmer network spread. Amul sources milk from 36 lakh farmers across Gujarat. This vast base spreads procurement risk. If drought affects one district, others still maintain supply. And all of that basically ensures that the supply chain is not interrupted. And even if there is a challenge with one supplier, it will still not lead to production halts. On a business level, it it focuses on strategic growth and market positioning. Okay, say for example, a company is entering a new product category, or it is entering a new segment to spread the commercial risk. Reliance went from refining to retail to digital. Originally dependent on petrochemicals and refining, highly cyclical in nature, it diversified into telecom and retail. These new sectors now contribute over 50% of the consolidated EBITDA. When oil prices fluctuate, consumer and data businesses stabilize the earnings. The Tata Group, which operates in steel, IT, consumer products, auto, and hospitality. Economic downturns hit one sector but not all. TCS often offsets manufacturing volatility, and Tata Sons Holding Company uses this as a natural hedge. Mahindra Group, it has gone from tractors to finance to tech. I mean, think about it. Amazon is from e-commerce, cloud, entertainment, and so many different segments, right? Samsung operating electronics and construction, then shipbuilding, then finance. It's like literally everything under the sun. And diversification provides a hedge against business cyclical, against the industry cyclicality, and aligns with the concept of portfolio balance under the BCG matrix that we have seen. At the corporate level, when I'm talking about geography and currency diversification, uh, think about it. When I'm talking about Infosys as a global delivery model, it has delivery centers in India, Europe, and North America. It allows quick reallocation of work if one region faces disruptions. Or like specifically in a time like now, when there are visa issues in the United States, naturally, because they have delivery centers all over the world, it reduces the exposure. What Dr. Reddy's has done is Dr. Reddy's has geographical diversification in pharma. So Dr. Reddy's operates in the US, India, Russia, and Europe. If the US FDA issues a warning for one plant, other geographies will still continue sales. Right. So strategic diversification can be related. It could be in the same line or it could be in a completely different line altogether. See, diversification spreads risks, but it also brings in new challenges with it. Okay. Like managerial complexity. Uh, it is hard to monitor performance across unrelated businesses. Spreading your capital too thin, overextension, too many governance challenges, and cultural clashes. So when recommending diversification, also pair it with, strong governance, performance measurement systems, so that, that effective balance can be achieved that way. Okay, now let's move on to the next discussion.